from WBRN Radio in Boston and on the Bostonred Network. Numbers Man, our macroeconomics program that we present along with Cranston Analytics and the commentary here. We are responsible. The respected sources, whether it be Reuters, the BBC, etc., that falls upon them. The BBC, a different type of license there, Bloomberg, and others. But we throw that little caveat in there. Very interesting week here. Not a lot of statistics out, but we do have some anecdotal and documented evidence here this holiday weekend as we move towards it and the all-important retail season. We'll talk about Tesla here and their discrimination lawsuit, Target and their dismal figures, and various other things. And we even have some statistics from Zimbabwe. Zimbabwe, as many know, is under a coup at the present time, and the removal of their leader for almost 40 years, President Robert Mugabe. And where that goes, so this is the first time we were doing research for our program, BR on the World, which is our international program, which is here also on the Bostonred Network. And we found their official statistics. This will be the first time that we've actually used the statistics there. And I believe we also have one of the PIs from the market people. I think it's the U.S., one of the U.S. sectors. We'll put that in. During the holidays, usually don't have as much statistics. That will come at the end of or after the American Thanksgiving holiday, and the retail horse race is off. And we'll see that when we have the holiday itself and the after day and Cyber Monday, etc., Black Friday, whatever. Nonetheless, to Tesla, they responded to a class action lawsuit that alleges their California production plant was a hotbed of racist behavior. The lawsuit was filed on Monday by a former Tesla worker, Marcus Avon, on behalf of a group of African American workers at the plant, claiming that they were addressed with racial slurs, and the company had ignored that. This is fairly prevalent in the so-called new economy, high-tech economy. The automakers and these types of things, they're not unionized, and they really don't have a history of labor struggles in that's particularly in multicultural events. These operations have popped up. It's sort of in a vacuum. Many of them are based in Silicon Valley, which itself is not a hotbed of multiculturalism, diversity, whatever you want to call it. And thus they are put on the stage. And once you arrive on the stage as Tesla, you're on the you're listed as a market force on Wall Street, and then you take on a different level of corporate responsibility. Now, if you're just making little go-karts, so to speak, it's a little different kind of situation. But when you become a larger corporation with showrooms, and incidentally, they have their own showrooms. They do not have dealers throughout the country, and you have a brand name, so to speak. It is totally different. At Tesla, we would rather pay 10 times the settlement demanded in legal fees and fight to the end of the earth than to give in for extortion. This was a term used in the 80s, recall, being at the corporate project, as it was called at that time, operated by Operation Push. Yes, they had economists there, which was addressing entry into the corporate world. Basically, at that time, 7-Up, Dr. Pepper, some others there, in terms not only of employment of African Americans, but also dealerships, etc. So in other words, we went beyond just simply demands for employment, but demands for development and economic development within the communities. Because if you had a bottling plant, as in the case of 7-Up, doesn't mean as much now. They were bought up by someone else, or Dr. Pepper, or Pepsi, etc. You created employment within the community, and at the same time, the community was buying these products. The same thing with GM, etc. But the point here is there was no Tesla at that time, and the Tesla automobile is a luxury car. They're now coming out with, I think, something sub $30,000, which puts them on a plane with some other cars these days. Anyway, Vaughn said in the lawsuit that he was routinely called the N-word by supervisors, co-workers to begin working at the factory in April. But Tesla never investigated the claims. Tesla said it had investigated the disappointing behavior several months ago, involving a group of individuals who worked on or near Vaughn's team and fired 3 workers. The lawsuit was at least the third one filed this year against Tesla by African American workers. Vaughn's lawsuit also said he was fired in October for not having a positive attitude. I bet. Anyways, on their blog, Vaughn was not fired. He left when his 6-month temporary contract had ended. Tesla is a statement that is absolutely against any form of discrimination, harassment, unfair treatment of any kind. When we hear complaints, we take them very seriously, investigate them thoroughly, and if proven to be true, take immediate action. And the question here is if proven to be true. Let's move on here. I think we'll get to delivery services here, a little bit different anyway. The tight labor market, now that is something we do deal with, is putting pressure on margins for freight handlers, warehouse operators, as they bid for hundreds of thousands of workers to move packages during the peak holiday season. Big picture here of a UPS truck. Transportation delivery services from UPS to FedEx and Vina Enterprises are raising a pay beyond national averages, offering attendance bonuses, adding new attractive trucks to their fleet. Incidentally, some of these, I was informed by an individual, actually have the drivers themselves. UPS is a union shop. FedEx is not. FedEx we're talking about here, that some people actually lease their own trucks. They have the FedEx logo on there. Competition for seasonal workers has intensified, as Amazon.com and others have set ambitious hiring goals in anticipation of strong holiday shopping. A risk for established delivery and truck companies is that Amazon, which has beefed up its own delivery operation, could use its network more instead of paying vendors higher prices. Transportation companies also weed out applicants who fail a drug test, face disruptions from summer hurricanes that idled thousands of workers. The additional costs are pension margins. Some of the biggest logistics companies, trucking giants Schneider, Knight Swift Transportation Holdings, and flatbed carrier Dorkin missed their reports, targets, I should say. For UPS, costs pressures from peak season hiring and higher purchased transportation in certain locations could pressure margins. That's according to Allison Landry. She's an analyst at Credit Suisse. Trucking and delivery companies will try to offset higher wages by raising, of course, their prices, as according to Craig Fuller. He's chief executive of Transris, which creates trucking future contracts there. The truck contract rate will increase between 6.5 and 12.5 in 2018. The top of the range of is record-setting for the industry, and a significant portion will go to drivers' pockets. That's good news for the workers. The companies are seeking ways to offset labor costs. UPS rolled out peak season surcharges for residential packages and has announced an increase in 2018. Separately, workers at UPS sorting facilities are using Bluetooth audio links to mobile devices to receive live communications on package routing, eliminating some 40 hours on-job training. The rival, non-union one, FedEx is building out a network of drop-off locations to reduce residential delivery costs, which are higher than drop-offs to businesses. Economists estimate a faster wage growth as the labor market nears a full employment. The employment rate is now, of course, at 4.1%, the lowest since 2000. Drug testing to get seasonal workers, employers are easing some hiring criteria, but keeping others in place. Trucking firms, of course, would have drug testing. Wiener hires just 2.7% of roughly 100,000 drivers who applies. Eliminates more than 1,000 applicants who can pass hair follics or urine tests. It's difficult in this market, not only for Wiener but for other carriers. The chief executive, John Steele, told Reuters at one Seattle terminal managers dropped requiring seasonal drivers to know how to operate a manual transmission. And they still had manual. I guess they do. Offered $700 bonuses who show up every day for a week. Well, that's an interesting situation. Nonetheless, the median pay for truck drivers rose 4.1% from last year to $52,627, according to the website Glassdoor. Well above there at trucking firms hiring wages in the past year. Industrial employment has followed. That's according to Stephen Volkman from Jefferies. UPS is using a message app, Snapchat, to find workers in competitive markets like Portland, Oregon, and Chicago. UPS Global Recruitment Strategies Director said they're seeking 2,700 rural drivers to deliver packages using their own cars. Now, that's another pilot program there. He declined to provide how close to reaching their goals of 95,000 seasonal workers. The labor market definitely makes it more challenging, no doubt about that. Higher paid lured a Seattle college student there named Lampion Martin, to UPS as a seasonal worker. The now full-time worker delivers packages for $18 $0.69 an hour plus overtime, well above the city's minimum, no doubt about that. But I believe Amazon is hiring people at about 70, depending on which market. I bring things that are eagerly awaited. Said during a ride-along last week, I feel like Santa in a brown suit. Well, I suppose he is Santa in a brown suit. Labor market being very tight. It's sort of like during the Second Gulf War. They had bonuses for people signing up for the military, bonuses for people sticking around in several $1,000s, $5,000, $10,000, what have you, for military service. I think those bonuses are no longer there, and other kinds of perks for people going to university. They received substantial payments there. So those kinds of incentives are there. Now, in broadcasts to come, we'll have something on the military pay. We did a little situation on veterans, talking about veterans. I don't know. We probably don't still have it up on a Bostonred, the number of veterans out there, and of course the number of people in the military all at the same time. Target signals another weak holiday quarter. Shares tumble. This was on the 16th. We're now on the 18th of November. Holiday quarter profits forecast fell short of analysts' expectations, setting the shares down 10%. Target missed the Wall Street fourth quarter profit expectations for the past 2 years. It is gearing up for the holidays by cutting prices and introducing delivery option to compete with the Walmart enterprise. It was always unrealistic that Target was going to have a great holiday season in terms of sales and profitability. That is from Neil Saunders, management of global data retail, noting margins are pressed on them. There's still a competitive environment. Target has no choice but to respond to it. The problem is Wall Street doesn't necessarily understand as well, and not that interested, really. Holiday seasons can represent 20 to 40% of annual sales for many retailers. And now that has dropped. It used to be much higher than that, some only about 20%. In October, Target said most of its holiday gifts would cost less than $15. Very unbelievable. That's kind of interesting, too. Looking at some of the pricing here, and lower pricing could get one into more deflation than inflation. Now, petrol prices, we'll get to those, have actually went up. So in other words, what happens in this economy, we have a model called seesaw model that talks about perhaps one sector of the economy going up, another sector of the economy going down. There is no stability there. It also hired 100,000 temporary workers, up from 70,000 each in the prior years, whereas Walmart has hired none. It raised its minimum hourly this year by 10%. Target shares have lost about 17% since the start of the year, and we're down 9.2% at $54.59. Not unmistakable these days. The third quarter gross margin slipped to 29.7% from 29.8%. That's the chief financial officer there, Kathy Smith. And it's still not bad. Target's trying to grab more lucrative holiday toys following the September bankruptcy of Toys R Us. Well, that's one of the things also happening. A lot of people are getting out of the game. Even J.C. Penney is having a lot of sales, and Sears as they close their shop. In other words, many of the stores that they have now offering sales, but they're also what we used to call going out of business sales. Third quarter same store sales topped the estimate, ranging from 0.9% in the quarter as price cuts drove a 24% jump in comparable online sales. Analysts expected 0.4%. That's Thomson Reuters there. A turnaround announced in February. Cornell, I guess is their chief executive officer at the Target Empire, vowed to double the number of small factor stores. Now, that's kind of interesting. At one time, we, at least in the U.S., went to all these superstores. Now, the superstores, there's still some around, but less superstores. Most small factor stores, which not only serve as stores, but also pickup points. Heavily in e-commerce, aggressively promoting products and keeping grocery prices low. Of course, they're competing now with Walmart, the Amazon empire, and Kroger, who's is in the business. The chief merchandising officer, Mark Trenton, said the compatible grocery sales rose slightly, helped by demand for product. Interesting to find that out. But the pricing pressure on groceries is continuing. There's never been large margins in groceries. What happens there is retailers actually pay these markets to place their items on the shelf. So there's a lot of that going on there. I guess in radio we call it payola. Anyway, pricing pressures continue to intensify. Excluding items, they earned 91 cents per share in the quarter that ended in October 28th, beating an estimate of 86 cents. Sales rose 1.4% to 16.67 billion, topping the average estimate of 16.61 billion. In other words, 0.6% more. Well, that's kind of interesting. We'll be watching to see what happens with the other retailers out there. And let's see, this is all from the Reuters empire. Somewhere is Foxconn here. Their profits incidentally tumbled. We have them up here someplace. Yeah, tumbled in the third quarter. They're out of Taiwan. Reported a 39% slide in quarterly profits, far worse than expected. As the iPhone X, there are bottlenecks in production. 10th anniversary, 10 years at the X, and X in the Roman numeral means 10. Struggled with specifications for new features such as facial recognition, edge-to-edge displays. Red hot demand for the product, which went on sale this month. Apple has predicted strong holiday sales and said it's happy with how it's being manufactured there. The world's largest contract electronics manufacturer, formerly known as Anha Precision Industries, third quarter tumbled to 700 million. There's some 42% below the estimate by analysts. First quarter decline it was first quarter decline in the year, marked its biggest profit drop in the quarter since 2009. That was a depression. The November-December should be better, but still won't impact overall Q4. Some analysts have attributed the profit slide to an appreciation in the value of the yen, yuan, and to labor idle to later than a usual launch for the iPhone. Nice picture of an iPhone here. The iPhone 8 kicked off sales, and a lot of iPhones out there in September in line with previous new phone launches, and consumers' demand was lackluster. They were waiting for number 10, the X, to come out. Is widely believed to be the sole manufacturer for the X. It's a bulk of iPhones at massive plants in China. And these are the people that are building a massive plant in Wisconsin, not very far from Chicago. One of the big problems here, and this is something they didn't talk about, hailing the plant deal there in Wisconsin, they're subject to market forces. Period. So that in itself excludes many things that would normally happen, and you need to always look at those things there. From Mark Cuban, now this is a tax situation here. Mark Cuban says tax rates have almost no impact on investments. Excuse me. He's a billionaire entrepreneur. Remember when he was working for Computerland? In fact, we helped him get on the internet a long time ago. Anyway, a cut in U.S. Corporate rate has little effect on his investment decisions. The bill before the House and Senate would cut the rate effectively from 35 to 20%. It has passed the House, stuck in the Senate. Cuban said the tax rates had zero impact on decisions whether to invest in small business, as he does through the reality show Shark Tank, and has no effect on decisions for his lineup of tech and entertainment companies. Competition drives what I do in my business a whole lot more than tax rates. That's what he told the Reuters filmmakers, entitled "The Trump Budget." and it was moderated by Harry Evans. And I think we had that. We'll see if we can get it and put it on the end here. Amazon is going to affect a lot more companies and futures as well. Microsoft, Facebook, Google, and other big companies a lot more than marginal tax rates. Now, marginal tax rates, we're glad we brought this in here because it effectively, in the past, now if you go back, say, to Reagan tax cuts, there, and you remember tax rates were very, very high in 1980, for those of us who were around 1980. But now it's a different situation. The whole ballgame, we didn't have globalized trade at the time. Now we do. And we had a manufacturing economy, basically speaking. And now it's a service type economy, totally different kind of type economy. We have the Facebooks, the Googles, in the automotive sector, the Tesla, which is not a union shop, which will probably be one eventually if they want to be a national car maker now. They're, of course, in the semis and satellites and what have you. But these types of businesses are not dependent on tax rate margins. In other words, dropping 15% doesn't mean as much to them. These tax cuts were designed around old hat businesses there, and the problem there is that most people don't understand is that under the present tax code, no one is paying 35%. Period. The deductions that corporations get, the placing of their assets offshore, well, amounts to this. And the whole thing is, well, if they bring the assets back, called repatriation, will that affect things? No. They'll keep the money. Alan Blinder, he's a Democrat, former vice chair of the Federal Reserve Board of Governors, said that data going back decades have failed to show a correlation between tax rates and subsequent growth. He's correct about that. Dr. Mark Zanni, chief economist at Moody's Analytics, he was the tax advisor to Senator McCain in 2008. Tax matters and constructed tax policy can improve long-term growth, but not nearly as much as anticipated by the Trump administration. In any case, the House and Senate proposals are very bad tax policy. And Dr. Zanni is one of the foremost macroeconomists in America. Now, Moya, Bassus Moya, he's a Zambian-born global economist, said technology, demographics shift as immigration and debt has far more impact than tax on growth. And the problem with the tax cuts, when you talk about $1.5 trillion, you're advancing, that's over a 10-year period, you're talking about additional debt. And you once more run into the problem, you can predict that, we'll pay this debt off, bump. But if you don't have demand, no matter what you give people in terms of that. Now, to individuals, yes, you will create something in this consumer sector. If people, say, get an extra $500 or an extra $1,000 back, that will be spent immediately, more like an extra $500. Anyway, Mark Cuban argues that the best tax cut to spur growth would be the employment tax reduction, such as a 2% point payroll tax reduction that the former President Barack Obama signed during the Depression. Employment taxes are both by workers and withholding from wages and employers, unless you're self-employed. Anyway, he was once a Trump supporter. He endorsed Hillary Clinton. It's about members of the audience he responded to. And this is an overall view of much of the business community, unless it is the old hash business community. Now, you have to separate those out. Now, if you start talking about the Exxons of the world, those kinds of mining conglomerates, many of the American manufacturers, and certain others, they would be the ones that would benefit some from marginal rates, but they don't pay marginal rates. So in other words, if it goes down to 20%, so what? Because they they aren't paying the 35% to start with. So in other words, it is a situation here. Let's see if we can get the budget debate up here. Hopefully we can find it. We had it at one time, and it is somewhere on the enormous desk, but we don't know where it is at this point in time. We'll have to find it. Anyway, we will find that. They actually tape this budget debate when Reuters. Now, the Trump budget debates Back to the Future of the 80s. That was a movie, incidentally. Reagan, the great communicator, and now Trump, the great Twitter artist. He cited the aging B-52 bomber, which the Air Force had trouble keeping in the air in the 80s because of a lack of spare parts. Anyway, I'm not sure what this had to do with anything. This is the Washington Post, and I'm doing this very quickly. The federal government debt passed $1 trillion in Reagan's first year in office, and approaching $20 trillion now. So, different situation. Where did we get this from? Oh, Mr. St. Louis Post-Dispatch out here. And, one never knows there. Anyway, we'll find this and put it on. Let us roll on here. Merrily, as they say. Something for the holidays here. Let's see. Amazon, of course, cutting prices over at Whole Foods. They now own Whole Foods. And we'll finish this up and go to the BBC. Let's see, when was this? On the 16th, we'll offer more discounts, steep price cuts there at Whole Foods. Whole Foods used to be very, very expensive. They made this $13.7 billion acquisition there. Investors have closely watched the price cutting at Whole Foods since the Amazon bought them. It's exactly what other stores competitors have been fearing. Well, no doubt about it, because they can turn it into a Kroger or whatever. Shares of rival Costco and Kroger fell on Wednesday morning between 1% and 2%. The Target also moved lower. The problem there is with Amazon is got a lot of flexibility to move, because they can use their Whole Food stores as pickup points, even drop-off points. Prices of food are still higher than most grocery stores because it caters to an upmarket clientele. There's no doubt about that. But at the same time, they can bring it down. Instead, Whole Foods will sell organic turkeys for what? $3.40 a pound to all customers, while Amazon Prime members can buy it at roughly $2.99. So, in other words, in some of the other markets, not organic, but turkeys are it's $79 to $1 a pound. So, in other words, it is a little bit different. But now these are organic types of things. Trader Joe's last month, Amazon previous price cuts on items, including bananas, avocados, and beef. Customers away from Walmart, Trader Joe's, and etc. And that is what they're trying to do. We used to call it loss leaders. They are now more into loss leaders than ever before. Let me just pull up, before we forget, on the energy sector here. Where is it? Hopefully we can find it. Now let's look at this while we're here. Digitization of the American workforce. This is from Brookings we'll just briefly go over it, but nonetheless is digitizing at an extremely rapid pace. And talking about the sectors that are in high digital levered occupations: software developers, applications, computer systems analysts, financial managers. In medium, lawyers, automotive service technicians and mechanics, registered nurses, office clerks, general, and below in security guards, cooks in restaurants, construction laborers, and personal aides. Well, yeah, so far so good. In 2002, 56% of the jobs studied required low amounts of digital skills. Nearly 40% of the jobs required minimal skills, and just 5% higher skills. A lot have changed. By 2016, the share of jobs requiring high digital skills have jumped to 23%. The share requiring minimal skills, more than 48%, and a huge shift of job requirements in low digital skills to 30%. Additionally, virtually all industry groups saw their mean digital score increase from 2002 to 2016 through the degree of the spread of digital adoption, leading the digitalization rate of a group of broad sectors, including professional, scientific, technical services, media, financial, insurance, at 55% there. Digital associated with increased pay and job resiliency in the face of automation, but also vastly uneven trends for job growth, wages, sharp gender, and race. And that's where we start off, and racial challenges exist. Job growth, has been rapid in high digital occupations such as computer, mathematical, and business finance occupations, as well as low digital level occupations such as personal assistance, personal care types, food preparation. The wages, the annual for workers in high digital is about $72,000 a year in 2016, whereas workers in the middle part about 48, and in the lower part about 30,000 a year. Automation provides a degree of protection for workers against task displacement through automation, while 60% of tasks performed in low digital occupations appeared susceptible to automation. Only 30% of tasks in the higher. I think that'll change. Anyway, wage growth between 2010 and 2016, occupations with high level registered more than 0.8% wage growth, not a lot. The middle 0.3 and 2% gender. Women with higher aggregated digital scores than men, they're at 48, and men at 45, represent 3/4 of the workforce in many larger medium digital occupations such as healthcare, office automation, education. Conversely, men continue to dominate the higher level digital occupations such as computer, engineering, management fields, as well as low digital occupations as transportation, construction, natural resources, building, and grounds occupations. Race and ethnicity, and we'll finish this up. Europeans, 65% of the workforce remain overrepresented in high level digital occupations such as engineering, management, as well as medium level, and that is really more important to when we look at it, areas such as business, finance, arts, legal, education, professional. Asians at 6% of the workforce account for 21.3% of high digital computer and math occupations, and 11.6% of engineering. African Americans, 12% of the workforce, are overrepresented in medium digital occupations such as office, administrative support, community, and social service, as well as low digital jobs, transportation, etc., building and grounds maintenance. Latinos, 17% of the workforce, are significantly underrepresented in the high digital, technical, etc., and somewhat underrepresented in the medium level legal, sales, and education. Nonetheless, this is from Brookings. We found it here, which is a positive thing. We want to get this in to people where the digitalization is actually going. Now, let's move on here. Briefly, this is from Bloomberg. The shifting 4 years on college campus might be too many, and this is a shift that is coming. The basic cause of student loan crisis is no mystery. College tuition fees continue to soar while the earnings of recent graduates remain flat. It shouldn't be a surprise that a straightforward way to lower cost of college, reduce the time it takes to earn one. The 4-year degree, that has really been out for a very long time, is based on a cultural convenience and not on the wisdom of wisdom. In most European countries, as well as India, Singapore, and Australia, the majority of undergraduate programs take 3 years to complete. Some U.S. colleges allow entrepreneuring students to finish their requirements early. There's no doubt in information technology, they have a master's of computer science that is a 4-year degree instead of, say, being 5 or more. Period. The Purdue University of Public School, that's in Indiana, enrolls 31,000 undergraduates, announced 3-year option open to incoming students pushing liberal arts degrees by carrying a slightly heavy course load. Well, we did that back in the old days. The university provides dedicated advisors, etc. The planned benefits are they save about $9,000 if they live in state, $18,000 if they live out. I'm not sure why they would be going there anyway. Not everyone is a traditional college education. Well, no doubt about that. It is a different situation in a different time. Let's roll back over to the BBC here. What we need. Well, Norway should drop oil and gas stakes. I'm not sure what that is all about. We'll take a look at it. There was something here. Well, anyway, we already talked about Tesla, so we won't get into that. There's a second Bitcoin vote. I'm not sure if that would happen. Nonetheless, Norway's state funds need to drop the oil and gas investments. Norge Bank manages Norway's $1 trillion fund. That's a sovereign fund. Said the step would make the country less vulnerable to permanent drops in oil and gas. Period. Around 6% of the fund, which is worth 28 billion pounds, is invested in oil and gas stocks. The advice is based exclusively on financial arguments and analysis of the government's total oil and gas exposure. Norge Bank proposal would now be reviewed by the finance minister in Norway. Norway is Western Europe's biggest oil and gas producer, and its sovereign wealth fund, known officially as the government pension fund, is used to invest the proceedings of the oil industry. That's been around for a while. Norway, a very small state, a country, needlessly shares in major companies such as Shell, BP, Exxon, Alltrade, Lower, after the announcement, no doubt about that. So it's worth... The risk of the oil sector is that many investment funds will downsize their exposure to exclude the industry. That's from Jason Kinney, oil analyst at Bank Santander, excuse me. Another analyst, Liz Delon, said the move was no real cause for concern. Nothing is immediate, and even if the advice is fully implemented, we believe this will have a limited impact on oil and gas producers, as the holdings of Norges Bank are relatively small and no doubt will be deposited over extended frame. No doubt it would be over an extended frame work, as one would say. Not something immediately happening out there. There was one other story here that we wanted to get, and I guess we won't get it. Well, anyway. Let's go. Where are we? Oh, this is from ISH Market. We usually have them. This is the U.S. Business Outlook on the 13th of November. Optimism surrounds a future output increase to its highest in 3 years. New business and profit expectations are also strong. Job hiring intentions reach a 3.5-year peak. Now, the latest business outlook indicates a strong degree of confidence within the U.S. This has shown a net balance of plus 37% of companies forecasting growth, highest since 2014. Expectations are also influenced by more robust client demand and larger customer base. I do it every time. The supply chain pressures and possible changes in government regulations were identified as potential threats to growth. Manufacturing service providers also forecast solid expansion in new business over the year ahead, with overall optimism around work reaching its highest in 3 years. Greater client activity and expansion into new markets have been cited as a reason for anticipated rise in new orders. With positive expectation for business activity and new orders, firms forecast the strongest rise in business revenue since 2014. Expectations regarding future selling price are meanwhile at their highest level. Forecasts for output price inflation has been largely influenced by expectations that higher input costs will be passed on to the consumer. So this is one of those strong output predictions, relatively muted inflation. Future investment plans are subdued in the content of series history. This is despite the optimism improved in the second highest since June of 2016. Firms in both manufacturing and service sector forecast similarly increasing capital expenditure over the next 12 months. Let's make sure. Notably, U.S. firms have a large degree of optimism regarding future profitability when compared to the global average. Employment and investment plans, favorable forecasts regarding new business and activity underpins prediction of future job creation. Strongest since 14. Inflation expectation foresees a rise in business costs over the year, driven by supply shortages, I guess, is in the case of the iPhone situation. A little commentary here. This is from Stan Jones. The latest market, ISH market, business outlook data signals strong expectation with regard to future activity, new business for the year ahead. Both reflect new orders, etc. And the private sector firms have plans for hiring also forecast to pick up in the coming years, provided they can find anyone. In line with greater confidence, business revenues are forecast to rise at the quickest pace since mid-2014. That's 3 years ago. February profits are strongest since February of 2014. Expenditures on capital investment, however, predicted to soften. And that's an interesting indicator there within itself. Inflationary pressures look to set to remain relatively subdued, except for energy pricing. And let us move along here to the market. This is on a Friday, unless otherwise noted. The BBC Global 30 was down at 36.66. The FTSE All Share was down 4.62 on Friday. And in Amsterdam, they were down at 2.57. In Frankfurt, the DAC was down 53.49. In Paris, they were down 17.22. In Brussels, 37.82 in the negative there, and in Madrid, 78.30 in the negative. We go to Zurich, 36.79 in the positive, and to Moscow, they were down on Friday, 0.74. In Johannesburg on Friday, down 294.82. In Bombay, they were in the positive range at 235.98. In Karachi, 31.09. In Lahore, they were down 46.11. In Colombo, 39.57. And in Tehran on Wednesday, 56.10. In Sydney on Friday, 14.80. The Nikkei at 45.68. The Hang Seng in Hong Kong at 180.28. In Shanghai, they were down negative 16.34. And in New York, they were also down negative 100.12. The Nasdaq was down 10.50. The Merc, that is the commodities market out in the Midwest city of Chicago, was down 6.79. In São Paulo on Monday, negative 1046.17. And finally in Mexico on Friday, negative 648.42. On to commodities we merely go. Or at least we go. Brent crude, this is on Friday, was up $1.36. And futures at $62.71. The spot was down $1.51 at $58.58. West Texas crude was up $1.48 at $56.75. T-Boom picking and jumping for joy. He remembers $15 a barrel oil, which is basically where it is now in 70s prices. Nonetheless, the Forex, gold, let's see, where are we? Gold futures well, let me make sure when we get here. We got two of them going here at once. Anyway, it was up $4.35 at $1,284.35. Dubai Gold Futures was up $16.70. Not sure why that's happening. At $1,294. Silver was up 4 cents at $17.08. Oops. And 8 cents. Euronext Life futures. Let's see. Cocoa was down $35. And Robusta coffee was up $16. White sugar futures, I don't know why we even bring that in, was down $8.70. The Bloomberg Commodity Index, this was on Wednesday, at 85.59. And that is it. And that was on Wednesday. This will do it for Numbers Man, our macroeconomic program, sponsored by our friends at Cranston Analytics. And we'll have more numbers next week. Let's see, we'll be after the holiday season opens, either to a big bang or a whimper, or at least it'll open probably. Sales already going on. We'll get the impetus of Black Friday in there. I don't know. We'll have preliminary results as we move through November and start our entry into December. A little different kind of situation there. Have a good weekend, everyone, and we'll see you next week here on Numbers Man from WBRN Radio in Boston and on the Bostonred Network.